The dimensions of corporate finance we are going to see in today's topics. Actually, it will be more useful for the entrepreneurs or startup entrepreneurs, those who want to start a business, they can aware of the term finance. So finance means it is a cash, or we can say it is a money. Whenever you are starting the business, we need three important decisions. So one is called how much we are going to invest your money, where we are going to take the money, either from the relative side or from your own money, or you are borrowing money from the financial institutions or financial services, and how we are going to uh, take the money, either proportionate of own capital or borrowing money. Likewise, we have to decide, and how much money we require to manage the day-to-day expenses of the company. So for this, in financial terminology, they are using three important financial terms like capital budgeting, which will support for planning for your long-term finance. Capital structuring, where we are going to borrow money, how much money you are going to take from your pocket. So likewise, it will be supported. Similarly, the last point will be supports how much money you are going to spend in day-to-day management of the business. So, what do you mean by capital budgeting? Capital budgeting, it's a planning and managing of the long-term finance investments. Normally, it will be supported by the financial manager who will identify the opportunities in the market, particularly in the financial market. So, for example, if you take a chocolate firm deciding whether or not to open a new factory is a capital budgeting decision. So, before starting any business, first we have to analyze how how much money we need as an investment, what will be the return on investment. So, it makes a decisions whether we will accept the project or we will discard the project. So, likewise, we can use a capital budgeting techniques. So what will be the major questions will be asked in the particularly in the capital budgeting? So how much cash does the firm expect to receive? What will be the size of the cash inflows and outflows? When does the firm expect to receive it? It explains the timing of the cash flows. How likely is the firm to receive it? It shows the riskiness of the cash inflows. Sometimes we don't get the money due to various factors. It may be a political factor, it may be a social factor. So it may be anything. So sometimes even the project also will be stopped by the government in terms of an intermediate project because of various reasons. So it is also a possible cases. The second terminology what we discussed earlier is the proportionate of the capital what we are going to invest in the business. So we will have equity capital as well as a debt capital. It's nothing but as per your understanding how much money you are taking from your own money and how much money we are going to borrow from the others. So this will be called as a the proportionate mix of debt and equity, which will decide the commitment what you are going to do in the future. So we can say it is a long-term debt and equity. So whenever you use more debt, you are liable to pay more interest in terms of the debt capital. If you use more equity, so there is a problem of paying more dividend to the shareholders. So always we should have a optimal capital structure. So to decide this capital structure, a entrepreneur has to ask these following questions. How should the firm pay for its assets? How much should the firm borrow as a debt or equity? What is the least expensive sources of funds? How, when and where to raise the money? So these questions will be given an appropriate answer to decide the optimal capital structure of a company. So the third financial terminology for an entrepreneur is working capital management. It's nothing but it is the management of day-to-day expenses of the company. So we can say it is a short-term obligation of the company. So how much money they will need, that can be decided with the help of the following questions. How should the firm manage the receipt and disbursement of the cash, like current assets and current liability? What is the best way to manage day-to-day short-term assets such as inventory? How should the firm obtain short-term financing? Should the firm sell or purchase on credit on what terms? So these questions will explain what type of working capital we required, how much we required, how we are going to manage the short-term requirements. So this will decide to formulate the credit policies of the company, either in the supplier point of view or in the vendor point of view. Once again, we will have a sum of the terminologies which will be most required in terms of corporate finance for the entrepreneur or a startup business people. The three things are like capital budgeting, capital structure, and working capital management. So very in simple words, capital budgeting means it's a planning and managing a firm investment. Particularly we are planning for the long term. Capital structure, which is supposed to decide what will be the mix of debt and equity, because we should not neither more debt nor equity, because it will affect the business in terms of paying more interest or in terms of making the shareholders to participate in all management decisions. So both the case we have a troublesome for a businessman. That is why we are calling it as a optimal capital structure. The third one is working capital management. As I discussed already, we'll simply call it as a management of current assets and current liability. So what will be the role of Chief Financial Officer in these three terms, particularly long-term management, long-term financial management, and short-term financial management? These things will be guided by the Chief Financial Officer. So this will be a simple organizational structure which will decide how the flow of communication will be passed from the top level to the bottom level. Particularly how the management of money in simple way we can tell. So this it's an organizational structure what we are seeing in this slide. So it shows the communications to come from shareholder, board of director, and the board of chief executive officers and the president and chief operating officer. So under them there are three major heads. One belongs to the functional area like vice president marketing, vice president finance, and vice president production. But we are going to talk here only about vice president finance, what he is showing his role in management of the money. Under his control there are two persons. One is called as a treasurer, another one is called as a controller. So this treasurer will look after the major area called cash manager, credit manager, capital expenditure, and financial planning. And similarly, the controller will control the cash, particularly cash inflow and cash outflow. So for that, he control tax managing practices, cost accounting manager, data processing manager, and a financial accounting manager. So this treasurer and controller will look after the three aspects called capital budgeting, capital structure, and working capital management. So the treasurer and controller are under the vice president of the finance. Simply we can say chief financial officer of a company. So normally a company has to think on two aspects. One is earning the profit, another one is we have to maximize the company's wealth also. So these aspects will be under the control of chief financial officer. A financial manager will coordinate in the activities of the treasurer and owner, what we discussed in the previous slides. So chief financial officer or vice president of a finance, he will report to the chief operating officer and coordinate the activities of the treasurer and the controller. So CFO is concerned with the answering of the three basic questions related to the capital budgeting, cash management and liquidity forecasting, commercial banking, investment banking, credit management, dividend disbursement and share repurchases, financial statement analysis, financial analysis planning, insurance or risk management, merger and acquisition analysis, and also tax analysis. So in a nutshell, there are two things are played in particularly in the corporate finance. One is called capital structure, another one is called capital budgeting. So the very first thing, the capital budgeting decisions will be taken by the company based upon the cash flows, because there are different opportunities are available in the market to take the project. Project is nothing but it is a starting off of your business. Normally, whenever we are starting the business, two aspects are very important. One is called how much money we are going to invest, what will be the return from the investment, how much period we have to wait to get back your investment. Simply we can say return on investments. So it will be decided by the firm finance manager. So whenever we decided we are going to start the business, then the next question will be arise how you are going to raise the capital for starting the business. There comes the word of a capital structure. So the capital structure which we will design in this slide, so we can make in two proportionate. One, as I told already, we can have take it as a equity capital as well as a bond as well as a debt capital. So debt capital will incur interest, equity capital will incur dividend also we have to pay. So whatever the cases, so even for the financial manager, he can raise capital either by 50-50 or 60-40 or 30-70, depends upon the ability of repaying the interest and the payment of the dividend. So after the deciding, they have to think over about the payment of the taxes. So it depends upon the company where it is located. Similarly, nature of the industry is also decided how much tax has to be paid. So this will be called as a two important aspect while starting off your business, particularly in the corporate finance, called as a capital budgeting and capital structure. So you can see in this slide the same what we have seen in the previous slide, but apart from the financial manager, he is responsible not only for the taxes, the government also will be responsible for ethical considerations, because the company should not cheat the investors on any aspect. So the government will have stringent norms to borrowing money from the equity or borrowing money from the debt to capital using financial institutions and financial services. So what will be the goal of a financial management? So there will be, these questions will be called as a goal of a financial management. What should be the firm objective? The maximize the market value, maximize the sales revenue or market share, maximize the profit, minimize the cost to avoid bankruptcy and financial distress, maintain steady earnings growth, maximize CEO wealth. So goal in a for profit business, a manager for the board of directors who represent shareholders and the owners. Goals is to make money for the shareholders. Shareholders are better off when the value of the stock is high. Maximize the current price per share of the firm existing stock. Manager should maximize the values of the firm's equity. So we know very well, always he has to think on two aspects. One is called profit maximization, another one is wealth maximization. While achieving this objective or goal for a business, so they have to make a cost management system. Whenever we minimize the cost, we can automatically maximize the profit. So goal in for a profit business, so it will suppose maximize the value of the equity. So whenever the company earned more profit, automatically the company will declare more dividend to the shareholders. When the dividend get more amount of shareholders, automatically many investors will start purchasing the shares in the stock market. So when the demand is more in the shares, automatically the value of the equity will be increased. When the value of the equity will be increased, automatically company image, goodwill also will be increased. So as I told already, the very important aspect is wealth maximization, which will support the company to grow further in their business career. What about these goals? These goals will be called as a maximize the customer satisfaction, environmental responsibility, and ethical behavior. For any businessman, three things are very important. They have to satisfy the customer. Second one, they should take the responsibility of the business environment. Third one, whatever the business transaction, it should be in a ethical manner. How value is created? So it will be created from top line to bottom. It means in the organizational chart, from the top level leaders to bottom level leaders, it must be created. One is in the form of increasing the sales, another one is decreasing the expenses. As I told, for any financial manager or chief financial officer, they have to have two dimensions. As I said already, they have to maximize the profit. How they can maximize the profit? In terms of increasing the volume of the sales. So similarly, when the profit margin has to increase means automatically they have to decrease the expenses. When the margin of profit has to be increased, they have to decrease the expenses. There is no other way in the corporate environment. So another aspect is how the value is created. The smart financial management also contributes to value creation. Right choice of capital structure, right choice in making investment, right choice in allocation of excessive cash, right choice in financing short-term cash shortage, right choice in determining the credit terms. So these things can be possible with the help of the relationship. So the relationship, there will be an intermediary for a business. For example, if you take a equity capital, we can raise money through the corporates or from the individuals. Similarly, if you raise money through borrowed capital as a debt, without the support of the financial institution or financial services, we cannot do anything better than other corporates. So we need some agency. So that agency relationship we have this problem. Particularly, the company should not have problems with these agents. So the agent, for example, as I told already, equity capital, if you want to raise means definitely there will be a shareholders. The shareholders may be a individual or maybe a company or maybe a foreign director investors, or even there will be a foreign institutional investors. So the agency is the one type of an intermediary will have a bridge the gap between the company and the sources of the funds. So agency relationship, as I told, shareholders can call it as a principals, and another one is higher manager, because if you want to bridge the gap between the shareholders and the company, we have to appoint an agent to run the company. Agency problem, always there should not have any conflict between the shareholders and the management of the firm. Cost, agency costs are defined as the cost from these cost conflicts of the interest. Normally, whenever we declared something to pay interest, that we have to try to fulfill the expectations of the shareholders. So, among this presentation, you may understand how the corporate finance has to be pursued in the market. So, whenever a businessman wants to start a business, he has to have three-dimensional, as we discussed in these slides. One is called capital structure, another one is called capital budgeting, and third one is called working capital management. So the very first task what we discussed is capital budgeting, either to accept the project or reject the project based upon the investment and cash flow of the project. Second one, after decided you are going to start the company means the next question will be raised, what will be the proportionate of the capital structure. When the capital structure has to be decided based upon the interest rate payment as well as the dividend payment. The third things will be raised, how you are going to manage the day-to-day business of the company. So that things will be explained in the form of a working capital management. Hope you all understand well. So with this, I will complete this discussion. Thank you.